This week, two numbers came out that almost nobody put side by side. The first number, more than $1.4 billion. That's the crypto-related income the sitting President of the United States disclosed earning in a single year on a federal financial disclosure form. The second number, 9%. That's the share of Americans who currently own any cryptocurrency at all, according to a recent survey, down from 17% not long ago. Bitcoin itself, after hitting an all-time high last year, has lost roughly half its value since. So here's the actual story of this video. While the man who promised to make America the crypto capital of the world personally collected more than $1 billion from crypto ventures tied to his own family, the ordinary Americans he was talking to when he made that promise have been quietly leaving the market in large numbers. By the end of this video, you'll understand exactly where that $1.4 billion came from, who was sitting on the other side of some of these deals, and why one specific sequence, connecting a stablecoin, a $2 billion investment, and a presidential pardon, deserves a lot more attention than it's gotten in the news cycle so far. Let's start with what this company actually is, because most coverage assumes you already know, and most people watching this don't. World Liberty Financial was launched in September of 2024, before Trump returned to office by his sons Donald Trump Jr. and Eric Trump, alongside the sons of Steve Witkoff, who would go on to become a U.S. envoy in the new administration. Trump himself is listed on the company's disclosures as co-founder emeritus. The company issues a cryptocurrency called the WWLFI token, along with a stablecoin called USD1, a digital currency designed to hold a steady value, typically backed one-to-one by real dollar reserves, unlike more volatile coins like Bitcoin. Here's the ownership structure, and this is worth sitting with for a second. A Trump family entity holds 70% of the stake tied to WLFI token sales, with other family members holding the remaining 30%. In plain terms, roughly 3/4 of the revenue this company generates from selling its tokens flows directly to an entity the sitting president personally owns the majority of. Now, let's get to the disclosure itself, because the scale of it alone tells you something. Every year, senior federal officials, including the president, are required to file a public financial disclosure listing their income and assets. For comparison, Barack Obama's final disclosure as president ran 8 pages. Joe Biden's ran 11. Vice President J.D. Vance's most recent filing ran 17 pages. Trump's 2025 disclosure, covering his first year back in office, ran 927 pages. Inside those pages, the crypto figures break down like this. More than $500 million from World Liberty Financial's sales of its tokens. An additional $236 million from further token sales beyond that. $65 million from selling equity in World Liberty's holding company. Nearly $290 million classified as income from cryptocurrency wallets tied to the company, and separately, $635 million in royalties described in the filing as coming from something called Celebration Coins, which reporting has connected to CIC Digital LLC, the entity behind Trump's own meme coin, known on crypto markets simply as the $Trump coin. Add it up, and you get crypto-related income alone of well over $1 billion in a single year for a sitting president. Some outlets, including the Wall Street Journal, have reported an even larger total when you include the paper gains on crypto holdings that haven't been sold, pushing the combined windfall for the Trump and Witkoff families since the company launched to somewhere around $1.4 billion in actual cash, plus billions more in unrealized gains on top of that. It's worth seeing that crypto income in context next to everything else in the same filing, because the disclosure shows this wasn't an isolated windfall sitting alone in an otherwise ordinary year. The same document reported more than $52 million from licensing the Trump-named property developers overseas, concentrated especially in the Middle East, a category of business the Trump organization had actually avoided pursuing during his first term, but expanded significantly in this one. It reported more than $80 million from legal settlements with media companies, and it detailed one of the largest individual stock purchases in the entire filing. On a single day in August of last year, 3 successive trades buying shares of Apple, Microsoft, and Nvidia, each valued at between $5 and $25 million. Federal ethics filings report holdings in ranges rather than exact figures, which is standard practice, but even at the low end, that's a notable concentration of new money moving into some of the exact technology companies at the center of the AI build-out we've covered on this channel before. Here's a comparison that should make the scale land. Trump's real estate empire, the business that made him a household name for decades before he ever ran for president, generated roughly $1.2 billion in cash over 8 years, from 2010 to 2017. World Liberty Financial generated a comparable amount of cash in about 16 months. Now, let's get to the part of this story that connects a stablecoin, a multi-billion-dollar acquisition, and a pardon, because laid out in order on its own timeline, it's more striking than any single headline about it. In January of this year, an entity connected to Sheikh Tahnoon bin Zayed Al Nahyan, a senior official in the United Arab Emirates, purchased 49% of World Liberty Financial for $500 million. The Trump family received $187 million of that upfront. A few months later in May, a separate company also run by people connected to Sheikh Tahnoon used World Liberty's own stablecoin to complete a $2 billion investment into Binance, one of the largest cryptocurrency exchanges in the world. Later that same fall, Trump pardoned Changpeng Zhao, the founder and former CEO of Binance, who had pleaded guilty back in 2023 to federal money laundering charges. Read that sequence again, slowly, the same way we walked through the Fed chair confirmation timeline in a previous video. A foreign investor tied to the Trump family's own crypto company completes a multi-billion-dollar deal with a crypto exchange, using that same company's stablecoin as the transaction vehicle. Months later, the president pardons the founder of that exact exchange, a man who had already admitted, under oath, to a federal crime. Nobody has proven that those two events are legally connected, but they are unmistakably both real, both dated, and both sitting in the same short timeline. And that is exactly the kind of sequence that deserves scrutiny regardless of which political side you're on. Here's a second thread worth understanding, because it shows you who actually bore the risk on some of these deals, and it isn't who you'd assume. World Liberty Financial took a stake in a small, publicly traded company called Alt5 Sigma. Alt5 then raised $750 million from outside investors by selling new shares at $7.50 each, and directed almost all of that money toward buying WLFI tokens directly from World Liberty at 20 cents a token, a price around 60% higher than what private investors had recently paid for the same tokens elsewhere. Where did that $750 million actually go? More than $500 million of it flowed to Trump-linked entities. $90 million went to entities connected to the Witkoff family. And what happened to Alt5's stock afterward? It fell more than 75%, down to around $1.70 a share. Major institutional investors who had bought into that raise, firms like Point72 and Soul Ventures, were left holding losses as the stock collapsed. The insiders who structured the deal got paid up front, in cash at the top. The outside investors who funded it were left holding the loss on the way down. That's not a hypothetical about how insider favorable deals can work in crypto markets generally. That's a specific documented transaction with named companies, named investors, and a publicly traded stock price you can look up yourself. Now, it's only fair to tell you how this has actually been received because reasonable people genuinely disagree about what it means. Democratic lawmakers have been the most vocal critics. One member of Congress, Representative Angie Craig of Minnesota, characterized the pattern publicly as corruption, arguing that instead of using the presidency to serve the public, these deals appear to put money directly into the president's own pocket. Staff for Democratic members of the House Judiciary Committee produced a separate report alleging the Trump family's various crypto ventures generated more than $800 million combined in just the first half of last year alone, a figure that, if accurate, suggests the pace of this income was accelerating even faster than the full-year disclosure alone makes clear. On the other side, a Trump Organization spokesperson responded to reporting on the disclosure by pointing to its sheer length and detail as evidence of transparency, not concealment, arguing that a 927-page filing represents one of the most comprehensive disclosures in presidential history, not an attempt to hide anything. And Trump himself, asked directly about the appearance of profiting personally while in office, has given a version of the same answer more than once, that the stock market is up, that everybody's portfolio is up, and that decisions about his specific investments are handled by other people without his direct involvement. On a separate occasion, pressed further on the same question, he described his holdings in terms usually associated with a blind trust, saying he doesn't personally direct the trades and doesn't speak with the people who do. It's worth noting that explanation applies more naturally to a conventional stock portfolio than to equity in a company his own sons actively run and co-founded, where federal disclosures list him as owning 70% of the entity, holding that specific stake. I'm not going to tell you which interpretation is correct, because whether this constitutes a genuine conflict of interest, a violation of the spirit of ethics rules that were largely written before a sitting president's family could plausibly run a billion-dollar crypto company, or simply aggressive but legal business activity by a wealthy person who happens to be president, is a real disagreement that serious, informed people are having right now along real political lines. What I can tell you is that every figure in this video comes directly from a federal disclosure document, or from reporting that cited it, not from speculation about a hidden plan. Now, let's connect this to the other number from the start of this video, because it's the part almost nobody's putting next to the billion-dollar figure. While all of this was happening, ordinary crypto adoption in the United States has actually been shrinking, not growing. A recent survey found that only around 9% of Americans currently own any cryptocurrency, down from roughly 17% previously. even as the administration has pushed policies aimed at expanding crypto's role in the financial system, and even with new options like crypto exchange-traded funds now available to ordinary investors. Bitcoin itself set an all-time high last year and has since fallen by roughly half. For comparison, about 62% of Americans own stocks in some form. Crypto ownership isn't just declining, it remains a fraction of how many Americans participate in the stock market at all. Here's why that gap matters. If you were an ordinary American who heard the crypto capital of the world pitch and decided to buy in over the past year or two, the data suggests you're now sitting on losses, roughly in line with Bitcoin's decline from its peak. Meanwhile, the family whose business ventures benefit most directly from crypto adoption and crypto-friendly policy converted a meaningful share of their gains into actual cash through direct token sales and upfront payments from investors like the Abu Dhabi-linked entity, rather than simply holding the paper gains the way a typical retail investor would have. That's not necessarily evidence of anything illegal. Getting cash out at a high point while the broader asset class later declines is, frankly, exactly what any sophisticated investor tries to do. But it does mean that when you hear the phrase, everybody's profiting, which Trump himself has used to describe this period, it's worth asking, honestly, profiting compared to whom, over what time frame, and who actually got their money out before the retreat. Here's the piece that makes this more than just a story about one family's business luck. At the same time, all of this income was flowing in. The administration has been actively pushing legislation aimed at making the United States friendlier to the crypto industry, with a crypto-focused bill reported to be gaining momentum toward a Senate markup during this same period. None of that means the legislation itself is written to specifically benefit World Liberty Financial. Broad crypto-friendly policy would lift the entire industry, not just one company. But it does mean the person with the most direct personal financial stake in crypto's regulatory environment becoming more favorable is, at the same time, one of the people with the most influence over whether that regulatory environment actually becomes more favorable. That overlap between personal financial interest and public policy influence is precisely the kind of situation ethics rules are usually designed to prevent or at least require disclosure around. And here, disclosure is essentially all that currently exists. There's also a more mundane, less conspiratorial explanation worth including for the crypto ownership decline, because intellectual honesty matters more than a clean narrative. Retail investor participation in any asset class tends to shrink after a painful drawdown. That's not unique to crypto, and it happened to retail stock trading after the dot-com crash too. Bitcoin falling by roughly half from its peak is, on its own, a fully sufficient explanation for why casual investors who bought near the top might have sold, gone quiet, or simply stopped checking the app. You don't need a conspiracy to explain retail investors becoming shy after a loss. What's genuinely notable isn't that ordinary adoption fell during a downturn. It's that it fell during the exact downturn in which the family most publicly associated with promoting crypto adoption was independently converting its own holdings into cash at a pace that outstripped nearly a decade of a previous, entirely different business. There's one more thread that ties this video directly back to a story we've already covered on this channel. In our video on the new Federal Reserve Chairman, Kevin Warsh, we talked about his notably crypto-friendly public positioning and about World Liberty Financial's own reported pursuit of a U.S. banking charter, the kind of approval that could eventually let a Trump family business apply for direct access to the Fed's core payment infrastructure. Nothing about that process has resolved yet, one way or another, but watching whether that charter moves forward and under what conditions is now a genuinely important thing to track, given everything we just walked through about how this company's revenue actually flows. So here's what to actually watch going forward, rather than a prediction dressed up as certainty. Watch whether World Liberty Financial's banking charter application advances and who ends up reviewing and approving it. A decision that, given the crypto-friendly leanings of the new Fed leadership we've already covered, deserves specific attention rather than getting lost in a routine regulatory filing. Watch whether any additional congressional investigations into these transactions produce findings beyond the initial staff reports we've already seen, and whether any Republican lawmakers, not just Democrats, eventually raise their own questions about the structure of these deals. That would be a meaningfully different signal than a purely partisan back and forth. Watch what happens to Alt5 Sigma's remaining investors, and to whether more deals using that same structure. Insiders paid up front in cash, outside investors left holding the downside as the stock falls, surface elsewhere in the crypto industry, because that pattern, if it repeats, would be the strongest evidence yet that this wasn't a one-time structure but a repeatable playbook. And watch the simple adoption numbers themselves. Whether that 9% ownership figure keeps falling, stabilizes, or reverses, because that tells you whether the everybody's profiting story was ever true for anyone outside a small number of insiders in the first place. Here's what I want you to leave this video with. None of this requires you to believe in a hidden secret conspiracy. Every figure in this video is sitting in a public document filed with a federal ethics office or reported by outlets across the political spectrum, including business outlets that have no particular reason to exaggerate against the administration. The pattern is simply this: a business explicitly built and controlled by a sitting president's own family, converting political proximity and crypto-friendly policy into over $1 billion in personal, realized cash during the exact period that ordinary Americans who bought into the same asset class have, on average, lost money. Whether that arrangement should be legal, whether it should be considered normal, and whether it should change the rules for how future presidents are allowed to run outside businesses while in office, that's a decision for voters and lawmakers to make, not for a YouTube video to declare on your behalf. What this channel can do is make sure you're looking at the actual documented numbers instead of a headline fragment, so that whichever conclusion you land on, it's built on the real filing, not on a version of it filtered through whichever side of the debate is telling you about it. If this helped connect a story that's been scattered across a dozen separate headlines into one place, subscribe. Because between the Fed chair story, the banking charter decision still pending, and whatever comes out of the next disclosure cycle, this is very much still developing.